I have created a system for myself to figure out whether a business is financially healthy or not in general. And the best place to look for in the annual report of a company to figure out whether the business is financially healthy or not is the balance sheet. So, whenever I am looking at a company, I download the past 10 years worth of balance sheet, the latest past 10 years balance sheet, and I compare these balance sheets. And that gives me a clear idea as to whether the business is financially healthy or not, or whether it has been growing or not. So, whenever I am looking at the balance sheet, the first thing I am looking at is what does the company own? What are the assets of the company? Now, the assets of the company are of two types. One is the current assets, and then you have non-current assets. Basically, in current assets, what do you have? You have cash. The higher the cash, the better. Then you have inventory. Inventory, the higher the inventory, the more problematic it is, because if the inventory gets stuck, my capital is getting stuck in the business. So I want a business where the inventory levels are low so that the products are moving fast. So first is cash, second is inventory, third is receivables. I compare receivables to the revenue of the company. So if my receivables are, let's say, 3% or 5% of revenue, then it is not much of a problem. But if my receivables are, let's say, 25% of revenue, that means 1/4 of my revenue I have not received in cash. So that's a big problem. So cash, inventory, receivables, and financial investments. Some companies invest in stocks, bonds, liquid mutual funds, and things like that. So the bigger the number, the better. So these are the four basic things when I look at the current assets of a company. There are other current assets also, but those are negligible. Then I look at non-current assets, basically the fixed assets of the company: land, building, plant and machinery. Then you have intangible assets also, like goodwill and things like that, patents, trademarks. So these are the non-current assets. This also include financial investments which the company doesn't intend to sell. Maybe they have invested in some subsidiary company, or they have some stock investments which they will never sell. So these are non-current assets of the company. So current plus non-current gives us the total assets of the company. I compare that total assets number with the revenue of the company. So let's say the total assets of the company are $50 million and the total revenue of the company is $100 million. So that's an asset turnover of 2 times. So the company doesn't require much in terms of assets to generate that kind of a revenue, which is a good sign. So that is why I look at the asset turnover. Another important thing that I look at is the invested capital. Invested capital is basically the money that is stuck in the business. So if you look at current assets, I don't include cash and financial investments when I'm calculating the invested capital. So basically, invested capital is nothing but the total assets of the company. But total assets minus cash, minus financial investments, minus intangibles, because cash is the money that the company already has. Financial investments is the money that the company has not is the money that is not stuck in the business. It is money that the business has invested in other businesses, right? And of course, intangibles. So out of total assets, if I remove cash, financial investments, and intangibles, whatever is left over is the actual money that is stuck in the business. That is what I call as the invested capital. And I compare this invested capital to the pre-tax operating earnings of the company, because I want to figure out on per dollar of invested capital, how much am I earning pre-tax on a pre-tax basis. So that gives me a ratio which I call as pre-tax return on invested capital. The higher the ratio, the better, because with return on equity, what happens is that if a company is making a lot of money, the cash amount keeps going up. And if I'm calculating the return on equity, the equity keeps expanding and the profit doesn't expand as much as the equity is expanding. So the return on equity keeps going down. But that doesn't mean that it is not a good business. So that is why I'm looking at the invested capital of the business, which I get from the total assets. Next is liabilities. I want to look at a company which has little or no debt. Now liabilities, there are two types: current and non-current liabilities. Current liabilities is basically the money that the business owes and it has to repay back in less than 1 year. So what are current liabilities? You have trade payables, you have made some provisions and things like that. Short-term things that the company has to repay in less than 1 year. Whatever fits that category is the current liabilities. The lesser the better. Then you have non-current liabilities where the main component is long-term borrowings. If the company has borrowed money for 5 years, for 10 years, that is the number that I want to look at. And I generally invest in companies that have zero debt or zero long-term borrowings or no or little long-term borrowings. That way my downside is protected. So those are non-current liabilities. Then you have total assets minus your current and non-current liabilities. What is left over is the equity of the company. So basically the assets minus the liabilities is the equity of the company, which belongs to the shareholders. And the higher the value of the equity, the better, because this is the money that actually belongs to the shareholders. Now I look at the past 10 years worth of balance sheet of a particular company and see how these numbers are growing. Is the equity growing? Is the debt reducing? Is the cash component increasing? Are the financial investments increasing? Has the company made any acquisitions? If there is goodwill on the balance sheet, that means the company has been acquiring other companies by paying a premium. So if I look at 10 years worth of balance sheet of a company, it gives me a lot of data. It gives me a clear picture as to what is going on in the business. And if I find a company which has got a lot of cash, has made a lot of financial investments, it has made some acquisitions, it has little or no debt, it has growing book value, that means it is a financially healthy business. So this is how I use the balance sheet to figure out whether the business is healthy or not. It's a very, very simple process. There is no need to use too many ratios. Just look at the numbers, put them on an Excel sheet, look at these numbers. And if you find in general that these numbers are growing, that means it's a good business. Thank you so much.